Welcome to the Plan Solutions Incorporated podcast. I'm Jason LaChance, and we'll be speaking with President of Plan Solutions, Chase Armour. Thank you for listening to the podcast. Hit that subscribe button if it's your first time. And we also want to thank all of you for listening and those that have been sharing. We continue to see a nice uptick in listenership, and we know that's because you're spreading the word. So we want to thank you. And the podcast is now available on YouTube. All you have to do is search at Plan Solutions on YouTube, and you will find the channel there where you can follow along to the personal financial review, the written content that we discuss here on each episode. And if you want to get subscribed to the personal financial review, send Katie an email. That's KATIE at plansolutions.com. Mr. Armour, how are we, good sir?
Oh, doing well. Just, digging out all the projects and things that got pushed off till after tax season. So that's been the last several weeks, but I think I'm getting close to caught up. So that feels good as we're heading into summer, maybe a little bit of free time.
I am with you. Well, the Kings aren't in the NBA playoffs. The Lakers are out. The Phoenix Suns are out. So I really have no interest in it. So my free time in the evening has completely opened up. So I'm with you on that.
Yeah. The Kings being out, that was a disappointment. But yeah, I got to say my interest in the NBA playoffs has dropped significantly since they exited.
I'm with you. Well, let's take a look at what we're going to discuss today. U.S. first quarter economic growth rate, look at home insurance cancellations. We're going to talk IRS audits and a look at the Plan Solutions Incorporated office bulletin board. So let's dive right into U.S. first quarter economic growth rate. Of course, we continue to talk about the economy, what's going on, everything from interest rates. And let's see, how did the first quarter really come out?
Yeah, this was kind of a surprising number. I think it was the big news at the end of April, where, we get the first estimate that comes out, for the first quarter about a month after the quarter ends. And then there'll be a second estimate. And then there'll be the quote unquote final number. But even that's not so final, as sometimes it can be revised, as they come out with additional data. So this was the first estimate, but I think it surprised a lot of economists, surprised the market, in that the U.S. economy grew just 1.6% at an annualized pace in the first quarter. So that was less than expected. And sure enough, when that report came out that morning, we saw the stock market drop quite a bit, just given the surprise. But, if we dig into the numbers, it appears that maybe the headline number is worse than what's actually going on. And I think we saw that reflected in the market as well, and that it sold off quite a bit that morning, but then, continued to kind of slowly recover throughout the day and actually finished up down a, fairly small amount once it was all said and done. Once I think, people had a chance to go in and dig through the numbers and kind of digest what's really going on.
Yeah, well, let's discuss some bright spots. What are some of the areas that we can focus on that, hey, these are some good signs?
Yeah. The bright spot, always the big number that you look at is the personal consumption expenditures. That's, 65 to 70% of our economy is basically all of the spending that, that we all do on a day-to-day, month-to-month basis. And that number increased by 2.5% in the first quarter. So, it's down from the 3.3% that we saw, the prior quarter, but still, and maybe we'd like to see it a little higher in the 3% range, but 2.5% is solid. And so it shows that the largest component of the U.S. economy, still remains in strong positive territory. And we've basically posted, consecutive positive quarters since the pandemic. Mm-hmm. So the biggest, most important part of the economy maybe weakened a little, but, big picture still looking pretty strong in terms of consistent growth.
Well, what are some of the other primary categories that we look at, and how did they turn out?
Yeah, so the second one I look at, which isn't necessarily the second largest, but I think it's significant, is gross private domestic investment. So this is the amount of money that's being spent as kind of long-term investment, whether that's in real estate, equipment, inventories, things like that, and that increased a solid 3.2% in the first quarter. So it shows that, both businesses and households are continuing to not just spend, but also invest for the future. And that's a good sign that the current growth phase in the business cycle may continue. And it was really encouraging that the residential segment increased 13.9% for the quarter. So if anything, we might be seeing a sign that, households are allocating money towards some long-term investments and maybe not quite as much towards short-term consumption, but still, are willing to shell the money out and keep the economy moving.
You think this is it? Just a trickling effect of, as you said, we're well removed from the pandemic, the lockdowns, more local businesses. I'm seeing more of that people are just getting more confidence in the economy and that investing their money is going to show some return.
Yeah, I think, we've seen the recovery last year. We're transitioning into a new growth phase here, and that's usually a good time to be thinking longer term and in terms of those bigger investment expenditures. I think also, people, households and businesses might just be somewhat adjusting to the higher interest rate environment. Felt pretty steady, and they might just be looking at it and saying, well, okay, I just can't put these investments off any longer. Yes, I don't like it that interest rates are higher, but it's they may be acclimated to the new level of interest rates and are moving forward with long-term plans, whereas maybe they're holding back a bit just because they were hoping interest rates would tick back down and there'd be better timing.
Yeah. Well, what about government? We always talk about government consumption and expenditures. Where does the government play a role in this?
Yeah, so that was one of the areas that I think dragged down the headline number. Government expenditures increased just 1.2%, whereas they averaged 4.6% for all of 2023. So that's a pretty significant slowdown. But if you look into the subcategories, the main contributor was a sharp decrease in federal government expenditures in national defense. But with the recent passing of the legislation to fund military aid to a number of U.S. allies, most of that money is the government purchasing national defense goods and services within the U.S. and then exporting those abroad, so that the money and the activity typically happens here, even though the product that's being acquired ends up being shipped somewhere else. So I think we're likely to see a big reversal in that area going forward with the billions of dollars that'll be running through the national defense sector going forward. So a little bit of a drop off in the first quarter, but not something that we would be real worried about going forward.
Well, what are some of the contributors to the slowdown? Obviously, we've talked about these three areas, and there's some good signs there, but there's got to be some where we are seeing some regression.
Yeah, the largest contributor to the slowdown in the pace of economic growth came from the balance of trade. And the way we calculate that is we basically take imports, right? Things that we're buying that were produced abroad, and we subtract it from exports, the things that we make and sell to foreigners. And in the first quarter, exports increased just 0.9%, while imports increased 7.2%. So that led to a negative trade adjustment of 6.3%, or basically negative 6.3%, which obviously is going to do quite a bit to drag down the overall headline number. But I think it's important, there's two important considerations when we look at trade data. So the first is it's often quite volatile. It can swing very widely from quarter to quarter. So the 1 quarter of negative data does not necessarily indicate a negative trend. In fact, what we tend to see is a really positive quarter followed by a really negative quarter, and vice versa. They kind of cancel out over time. The second, as we mentioned at the top, this is just the first estimate of the U.S. economic growth rate for the first quarter, and trade is the area that tends to get adjusted the most as information comes in. Basically, it's kind of a guesstimate, if you will, and the first estimate, because it's only a month away from the end of the quarter, and a lot of that data hasn't come in and been crunched and things. So it wouldn't surprise me if we saw those trade categories revised a lot more than you'd likely see in the other categories. which could, offset some of the negative impact from trade that we're seeing in these initial numbers.
So what do we really want to summarize about the first quarter here? I mean, there's some good signs and any of the potential contributions to the slowdown. It varies. We've talked about that before, the volatility sometimes of trade.
Yeah. I think, I think the takeaway is, the growth rate was lower than expected, but still positive. I think the fact that it missed estimates is a negative, but when you dig into the numbers, you see it's a pretty small negative. Something that could easily be offset in revisions, future revisions, or in future quarters. So it's not anything we can draw any real broad conclusions from at this point, but definitely something we'll need to keep an eye on going forward.
Yeah, one question I had about this that you didn't really touch on, but it raised my curiosity. Does economic growth have any factor in how the feds then look at adjusting interest rates?
Well, yeah. It's going to have an impact. I mean, the two main mandates for the Fed is stable prices, which is basically low inflation, and full employment, which is low. And right now we have low unemployment, so that allows the Fed to keep interest rates higher for longer, if they feel that they need to bring inflation down closer to their 2% target. But obviously, the economic growth rate is something that will affect the job market, right? The spillover effect. So the Fed will take that into account, saying, okay, the job market right now is really strong, but if in fact the economy is slowing, which I don't necessarily think is a conclusion that we can draw, going forward just yet, but if in fact the economy is slowing, that's likely to, weaken the job market. Maybe they need to bring interest rates down a bit to keep the economy growing, keep the employment market strong. So it is something that would be factored in, but I think it's probably a little early to assume that it's going to have a big impact on their policy decisions.
Thank you. And if anyone wants more on that, we did touch on it in the last episode as far as the job market. So you can go back in the archive and check out that episode. All right, let's jump into home insurance cancellations. Many people continue to get these notices. I know you had brought this up to me and kind of pre-warned me. But what's going on? Why are home insurance policies being canceled or not being renewed? We're seeing this interesting trend.
Yeah, it's creating a whole new source of risk or challenge for homeowners. We're seeing some insurers just leaving markets altogether, whether that's certain areas or states. We're seeing others want to reduce their liability. The cost of reinsurance, which is insurance that insurance companies buy from other companies to kind of spread the risk, has really increased. So in a lot of cases, it's made it difficult for them to be able to fund the insurance obligations. And depending on the state, there's a lot of states that they set insurance rates, how much they can increase those prices. And supply and demand, there's still high demand for insurance, but if the supply of companies that are willing to take on those risks are going down, that's typically going to push up prices, and arguably, some of the risks are higher, or the potential cost payouts are higher. So that also needs to push prices up. And in some cases where companies don't have the ability or the flexibility to raise those premiums to a level that makes it worth it for them to provide that insurance, they may just be leaving the market or just canceling policies altogether.
Yeah. Well, this is something that, any of us homeowners should definitely be prepared. I mean, there's the potential risk out there. What are some three areas that you might want them to know to mitigate some of the risk here?
Yeah, I think we all as homeowners should be preparing ourselves for this, right? Don't wait until you get that cancellation and then say, oh no, what do I do? Now I'm really stuck, right? You should almost be preparing as if there's a high likelihood that it's going to happen. Now, the first thing you can do, is if possible, take action to reduce the risk to your home, right? So that can be, creating defensible space, certain fire repressant or installing systems to reduce the risk of damage from fire or other perils, because that could give you Well, one, it could make you, more attractive as to an insurer. And two, the first option you have is if an insurance company is canceling or not renewing your policy, assuming they're not completely leaving the market, it is basically to ask them to reconsider. Right. And you can actually make that case. You could say, look, this is what I've done to reduce the risk. I'm probably the type of person or home that you want to be insuring. Even at, maybe the lower the needed premiums because the risk is actually lower. So at least maybe gives you an option of going back to the insurance company and maybe convincing them to reconsider and continue to provide insurance. The second, I think, is just be prepared for the financial hit, right? Make sure you've got some free cash flow set aside just in case your policy is canceled. Because in many cases, if your policy is canceled and you're not able to get other insurance, your mortgage company will obtain coverage for you because obviously they need to protect their investment. And make sure that mortgage is going to get paid back. And that often will result in a sharp increase in annual premiums. That type of coverage is not ideal. It's kind of a, last resort. But it may just be the reality for people for certain time periods that's what they have to go to. So, making sure you have money set aside or cash flow that will be able to cover those potential increases. And then the third is if you're in that situation, you can always explore getting coverage through your state's FAIR plan. So these are plans set up by the state. Generally, the coverage is much more expensive and not nearly as comprehensive as other insurance options. So again, be prepared for a sharp increase in premiums. And often if you have to go through the FAIR plan, you'll need to get other supplemental coverages, right? So that, you're getting a policy that is equivalent to maybe the traditional homeowner's insurance policy.
And how would an individual go about exploring a state's FAIR plan? Is this something they can easily find on a state website or, a good web search?
Yeah, that's probably a good start to to learn more about it. Usually if someone's insurance is canceled, I encourage them to talk to an independent insurance professional, someone who's knowledgeable that might be able to look at their situation and let them know what companies might still be writing policies. So maybe they can still get replacement coverage. But if not, right, if they go down that path and find out that's not a possibility, then yeah, they can get some resources on some of the other plans that again are not ideal, but hopefully at least would fill a gap until maybe this market starts to return or normalize at some point in the future. It does seem to be getting a little bit better, but yet we're still seeing pretty large number of cancellations and things. So it's still a long ways from where it needs to be in terms of normalizing.
Absolutely. All right, let's jump into IRS audits. We've discussed audits, we usually do annually, but it's always good to come back, refresh, maybe if there's some differences and changes. What do we want people to understand when it comes to an audit? We've talked statute of limitation, usually how far they'll go back. You need to keep records and so on.
Yeah. And, the tax deadline just ended, right? But the other deadline that people need to be aware of is that statute of limitations, which is basically 3 years from the due date or when the tax return was filed, whichever is later. So if you filed by the due date, then it's that April 15th deadline. 3 years into the future is how long it takes for the statute of limitations to run out. If you went on extension or you filed your return late, then it'd be 3 years from the date that you filed it. And a lot of people often think about IRS audits, but really that statute of limitations runs both ways, right? So the IRS has 3 years to audit or make adjustments to a return. In most cases, right? Now, if there's a gross understatement of income or fraud, or there's some other cases where the IRS can go back further, or even have an unlimited statute of limitations. But obviously, hopefully, none of those things happen, right? And so if you filed an accurate tax return to the best of your ability, yeah, you have to keep those records and be prepared because the IRS could come back 2.5 years from now and you still need to be ready to defend that return, even though it was quite a ways in the past. But the other part that works in the taxpayer's favor is that a taxpayer also has 3 years. They also have that same statute of limitations to do an amended return, to correct any errors or make any changes. And one, they could do that to claim a refund if the error's in their favor. On the other hand, if they find that they made a mistake or there was an adjustment that came in later and it results in some tax due, they can still go in and do an amendment and self-report that. So they reduce the risk that the IRS will end up finding it and assessing penalties, either underpayment or late payment penalties. Typically, interest will still be charged. That's pretty much always a given, but it's usually the penalties that can really add up. So self-reporting can, in a lot of cases, be a good strategy.
And I'm guessing if the error is in your favor, that the IRS doesn't accrue any sort of interest in your favor either.
No, they do. Yeah.
Oh, really?
If the error is in your favor and you file an amended return, the IRS will pay interest. In fact, generally the checks that people get on the bottom in really small print, it'll have a dollar amount and it'll have an amount and it'll show a dollar sign and INT. So which portion of the refund is interest. Of course, if you receive interest in a future year, that interest is taxable. So the IRS will also be sending you a 1099 for the interest portion that you'll need to report on the following tax return that you prepare.
Yeah, that was going to be my next question was, will they get you for the interest? But of course, anything else you want to add before we jump into the bulletin board?
No, just the idea that taxes are fluid, they do change. We have the deadline, we do the best we can to file by the deadline, but sometimes it just requires some continuing on and making adjustments over time, and that's a pretty typical process. If anyone thinks that something wasn't right or there's a change, it's a good opportunity to have a discussion and realize, is it worth filing an amended return? If the refund's really small, maybe it's not even worth doing, or, what other options may be available.
All right, well, let's jump on over to the bulletin board. We got one item pinned up this week.
Yeah, so Daryl and I went to the Financial Planning Association of Northern California's Spring Symposium, which was interesting. I was asked to come back again and give an economic update, which I've done for, I don't know how many years running. It might be 10 or 15 years. And usually it goes pretty well, although this time I think they set me up because they had another speaker, which was a little different than what they normally do. Normally, these talks are eligible for continuing education credits, right? So that's one of the reasons people go. But they did a talk that wasn't a continuing education. It was inspirational speaker named Robert Paylor, who he suffered a major spinal cord injury in the college rugby national championship game. And he went through basically his recovery and how he was able to, get to the point where he regained a lot of movement in his arms and legs and even can walk now with the help of a walker. For short distances and really this long journey that he's been on. And it was a great presentation, talked about just having the right mindset, dedication, and support to, be able to overcome those challenges. And really his 4 tools that he highlighted was, choosing your mindset, having a good mental diet, right? What things are you taking in to motivate you? Focusing on the controllables instead of all those things that you can't control, and practicing your perspective both within yourself and through others. So he was a phenomenal speaker. Sitting there listening to him, I just couldn't help but wish that they had let me go first instead of having to follow such a great presentation where it was inspirational, it was funny. He just really had a great story. So I think my presentation went okay, but I didn't get the standing ovation that he did, and probably rightly so.
Yeah. I'm laughing because I know that feeling where I've been called upon to speak on something for 15 minutes, and then you sit there and the person before you're like, oh goodness, this is going to be a long 15 minutes.
Yeah, yeah. Halfway through his presentation, I was thinking, this is really good. And then it dawned on me, oh no, I have to go next. This is going to be hard to come anywhere near the quality of his presentation.
Well, thank you for sharing. That's awesome. And I love that you and Daryl continue to get out in the whole Plan Solutions family and continue to be of service to others. Anything else you'd like to add, Mr. Armour?
Nope. Just hope everyone's having a good spring, as we head into May. The old saying in the market, sell in May and go away. Not necessarily because the market's bad, but it doesn't tend to do a lot over the summer. But it'll be interesting. We'll see if this year's different, just like last year was.
Well, we thank you for listening to the Plan Solutions Incorporated podcast, Apple Podcasts, Spotify, or wherever you get podcasts, including now YouTube. You can go to youtube.com and put @Plan Solutions and you'll find us. You can subscribe there and follow along to the personal financial review, which if you have yet to subscribe, please send Katie an email, katie@plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.